Hi, Jim Searing, Management Solutions. Today we're going to talk about the balance sheet, one of your other financial statements, as we've already gone over the income statement. Now the balance sheet is a little different from the income statement. As the income statement occurs over a period of time, your balance sheet does not. Your balance sheet is a moment in time, or a snapshot, or a picture. Snapshot. Snapshot. It's a picture. So generally speaking, when you look at your balance sheet, you're going to run it at the end of your fiscal year. In this case, we're going to call it the end of the calendar year. December 31, 2011. You might also look at your balance sheet at the end of a quarter as well. You're looking at your financial statements. I would also call your balance sheet the general health of your business. General health. General health. Okay, balance sheet, it's balances, it's an equation. Equation goes like this. It's your assets. Your assets, one side of the equation, are equal to your liabilities, or what you owe, plus your owner's equity. Okay, I'm going to draw a line down here. This side is going to balance with this side. They're going to be equal. So what goes into our asset? Assets are our cash. That would be our checking account and our savings account. Also would be our accounts receivable. If we had any securities, or stocks, that the business owned, not us individually, also was made up of our vehicles, our loans, not loans, vehicles, equipment, buildings, land. Pretty much all the good stuff in our company goes on our asset side. We're going to total all that up, come up with a total. I'm going to throw an easy number at it. Let's say $20. That's one side of our balanced equation. The other side is our liabilities. That's going to be made up of our accounts payable and any loans we might have out there. There's a short account. Total all those up. Bet a big number, $5. The last part of this equation is our shareholders' equity, our owner's equity. That's going to be made up of our any capital contributions, any money you would have put into the company at the start of the business, and our retained earnings. Now the retained earnings is going to be made up of, now we look at this, we're looking at our balance sheet, December 31st, end of the year, snapshot. Now when we set up our QuickBooks, or we set up our business, we chose, a fiscal year. Generally, most companies choose the calendar year, January 1st to December 31st. So our accounting software will do this calculation, and you're going to see it on there. So our retained earnings are made up of last year's retained earnings, plus our entire profit and loss statement fits right here. Our net profit this year, from this calendar year, plus this number. And that, in essence, is your balance sheet. Now, when I talk about this being your general health, the reason I say that is because it shows you, what your assets are. Shows you how much you owe in terms of loans and accounts payable. And it shows you this number, which another term for this would be your net worth. This could be considered your net worth. The relationship between your retained earnings, or this shareholder's equity, and your liabilities is very important if you want to go after any loans with a bank. So we consider this to be the net worth of the company. Obviously, you took all the assets you had and sold them all off into cash, so this was just $20. And you paid what you owed, that's what you have left over. So that's a simple route to the net worth of your business. Now, it's not exactly the net worth, because there's other intangibles in a business, but we don't record the intangibles on a balance sheet. That's for a later discussion. The other thing I want to discuss in another video is understanding what happens when you purchase a vehicle or a piece of equipment, a capital expenditure, or you're building. We'll have another video coming out about that. Anyway, basic balance sheet. Thank you.